Hey everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth, and I'm joined, as always, by John Creekmer, our founder and Senior Wealth Advisor. And John, we're going to talk about some current events in the economy
Mhm.
and markets as well, and kind of walk through things. As we are just getting past the 4th of July here, it's kind of a good time to check in and check the pulse of where everything sits so far this year and as we move into the latter part of this year. Before we dive into that, John, how you doing today?
I'll tell you what, I'm excited. We just finishing up July 4th, and it's actually one of my favorite holidays. I just want, from a historical perspective, it's one of the fondest and brightest memories of as a child. And I love like going to the fireworks, and I really like it whenever you're sitting there and they get those big boomers hit, and everyone kind of looks at each other during the grand finale and starts laughing. That's kind of how amazing it is. So love doing that. A lot of fun in the summertime, and so I'm doing great. But there's a lot of things that are moving. I know that I just saw an article this morning, and I pulled it up real fast. Um, Air travel demand is breaking records. And so, as far as demand for air travel breaking records, but airline profits are not breaking records. And yet, we know the cost to fly right now continues to move higher because of that demand. Frustration actually for me is growing when I travel, and so a lot of people at the airports, and so that is driving. We're seeing a lot of economic movement right now that's kind of interesting where things are at.
Yeah, there definitely seems to be some disconnects between maybe what's happening out there data wise, but then some of the day to day reality that we're seeing. But John, obviously, the last, let's just call it 24-ish months, the biggest phrase that everyone's been talking about is inflation and how the Federal Reserve is going to address inflation without wrecking the economy and putting us into a recession. And so far, to your point, inflation has come down over the last 12 to 18 months, and things look okay economically, but we're starting to see some shakes in the economy with some of the new data that's coming out. So, why don't you walk us through just kind of where we stand from an inflation standpoint, but also just looking at unemployment? That's a really key number that's pointing towards where we may be heading here in the months ahead.
Yeah, and so it's interesting when you kind of look at everything together. So a lot of times the news likes to put out there those headline numbers. Keep in mind, folks, with the news, they're not unbiased. They're there actually to make money for the company, and the way they do that is by getting viewership to watch. They can increase their advertising rates, and so reality is you have to listen to what they have to say with a grain of salt and actually dig deeper into the numbers. So we look at everything. Inflation. Let's just say the last 6 months has been trending to a range between 2.8 and 3.1% on an annualized rate. The Federal Reserve, they have a target rate of 2%. And, it's going to be, we still have a ways to go before we get to that target of 2%. Now, that being said, we are starting to see some things start to subside a little bit as far as in prices. And keep in mind, folks, we look at inflation. A lot of times they say that we're going to factor out the most volatile things. Well, the most volatile areas is food and gas. And so I don't know, most people, they need gas every day to drive in, and we need food every day to fuel our bodies. So I think those may be two of the most important things to keep our eyes on. But across the board, we're still moving and trying to get to that 2% number the Federal Reserve puts out there. But it's going to be a while till we get there. We are going to more of a soft landing where they're trying to navigate coming down from high inflation without bringing us into a recession. And so we're still kind of having slower growth, but growth is slowing down and just some worrying signs out there as far as with jobs and everything else.
Yeah, there definitely is. And so, John, I think a lot of folks, they're also seeing some of those worrying signs. And so they say, okay, well, that's great that we see these signs, but how does that relate to me and my personal finances and my investments? How should I be navigating this area? And one thing I've been talking to a lot of folks about is how the market can be irrational for longer than maybe what we think it can be. It can go up into the right for a longer period of time. So, John, how are we walking through comparing the economic data to where the market is today as we're managing client portfolios?
Yeah, so you always want to have your pulse or your ear down to the ground as far as what's happening in the economy. Look at last week's um, employment numbers. And so non-farm payroll data seemed positive. It was at a high level of 206,000 new jobs were created over the previous month. But when you dig deeper into those, Drew, what you see is that 82,000 of those jobs that were created were in the healthcare sector. And so created job just means a new job. Doesn't mean that possibly there's a brand new job created. It means that someone took a new position. They may have actually been out of the workforce for a while, or maybe they were actually doing travel. nurse or travel doctor, and now they end up taking a position full-time in one regional location. But so 82,000 in healthcare, another 70,000 were actually government jobs. So what that tells us is the government's continuing to expand, which we know that economically that's not a good sign for the economy. Whenever at this point 35% of the jobs created in the previous month were governmental jobs, and manufacturing jobs, which is more a telltale of what's happening in the economy, manufacturing jobs actually fell by 8,000. So we actually had 8,000 fewer people working in manufacturing last month than we had the previous month. And so whenever we look at that, it just kind of says there's just concerns right now as far as with employment. And keep in mind, folks, employment is really a leading indicator of what we're going to see in the economy. And so we want to keep on watching that. It's looking like we're heading again to a more slow growth. I wouldn't be surprised if we're sitting there close to a 1% growth rate or a little bit less than that for the full year. And then we look at some broader things that kind of cause a little bit of confusion. So gold and silver and copper are all moving up a little bit. Oil was at $72 a barrel. Now we're sitting around $82 a barrel. And so that really speaks to demand, to people traveling. And so across the board, we are seeing some mixed information out there as far as in the market. So the question is, what do you do with that? Well, you want to look at the market and say, where is the market at now? And how is it moving compared to historical terms and historical timelines?
Yeah. And John, I think that's a great point. We're going to put a chart up on the screen to show some of the research that we've done looking at past bull market periods. And historically, on average, a bull market will last for 18 to 24 months. And so our team actually went back over a number of decades and mapped out previous bull markets and put this chart together. That does a really good job helping us visualize where we are at today in the cycle. And so if you watch, let's go back here to 2020. In March and April of 2020, we had a big drawdown as the world was trying to figure out what COVID was going to do to the economy and markets before we went on a pretty incredible rally. However, now we get to the 18-month time period opening up here in July of 2021. Well, just a few months later, in December of 21, was when we hit the peak and began a large drawdown into 2022, where we all remember the S&P was down just a hair shy of 20% in that time period. Well, today where we stand, the 18-month window opened in March of this year, and the end of the 24-month window would be November of this year. Now, we're not saying the sky is falling and go to cash because everything's going to hit the fan. But what we are saying is we need to be cognizant of where we are at in the cycle and be logical with the type of things that are going on in the economy as it relates to where we stand in the cycle today. And so, John, when we look at the data, looking back at past bull run periods, we see cause for caution, not cause for put all your eggs in cash and waiting to see what happens, because the market can go up for a little bit while longer here. And so, John, when you look at that data and you compare it to what's going on in the economy, what do you think is most important to keep in mind?
I think something I learned probably 20 years ago, Drew, is actually in the 2000, 2001, and 2002. Is there so much that then again, if you think about 2000, that was just coming off a huge run as far as in the technology sector. We had the first iteration of the internet explosion. And in that period of time, the NASDAQ market just went up through leaps and bounds. The S&P 500 became more heavily weighted in technology. And so there were some big names in there were really running hard. And of that, then in 2000 and 2001 and 2002, in those 3 years together, we had 3 straight years of the stock market decreasing. It ended up being about a 50% total drawdown in that period of time. Well, I started recognizing that in that period of those similar periods of time, that your mindset is not to try to get the very last dollar made, and so a fear of missing out, quite honestly. And instead, your mindset needs to be the surest way to make money is not to lose it. And so new dollars going in, we want to make sure that we're really being thoughtful as far as how we're investing those dollars. And so that means that maybe we're looking to say, let's go a little bit shorter period of time. Let's look for investments that are either a strong buffer. So right now, Drew, we have a buffer that's a 12-month buffer and it's 100% principal protection. But you still have upside S&P 500 up to 9.5%, 10%. It's going to vary month to month, but somewhere in that range. So we look at that, maybe a call option in there, or some type of option strategy could be very useful with new dollars going in. Also, we have some very strong short-term rates, maybe a A 1 month, 2 month, 3 year ladder in a CD, you can still pull out 5.25 to 5.35%. And so you want to be thoughtful in how you're investing money. Drew, also right now we're seeing a rotation into higher dividend paying stocks. And so with that, we want to be thoughtful, new dollars going in. For dollars currently investing, it's always wise whenever we see a bop up. And so sometimes I think we had a bop up here recently on a couple of our large technology names, simply looking for opportunities to take profit. Now that doesn't mean that we don't like those names, we don't love those names. What that does mean is let's take some profit, let's sit in and make sure we harvest that profit. Remember, you do not make money in a stock until you actually liquidate the holding. And so let's take a little bit of profit, let's preserve the gain, and wait for things to pull back down a little bit before we invest. So a lot of it's being intentional right now in this season. And we kind of coined the phrase that where we sit right now in 18 to 24 months of an expansionary period is kind of called the kill zone. And you have to be careful that you're not stuck in the kill zone with no strategy.
Yeah, absolutely. So, guys, a lot of stuff going on right now. But if you have any questions about anything we talked about today, or just want to check in with your advisor and see, hey, what's our strategy with our investment portfolio today? We'd strongly encourage you to reach out to our team. We're all standing by, ready to help in any way that we can. But otherwise, we'll reach out to you all soon, and we'll see you here in a few months. Have a good one.